When a business owner or management team gets serious about running the business into their business, hires a CFO, or retains professional CFO support from a business advisor, I've found there are 6 major financial priorities and 6 major business risk priorities that must be analyzed and managed on an ongoing basis to create a sustainable business. Part 1 of this 2-part series focuses on the 6 major financial optics. If I were you, I would use this video as a template to help me get started and know where to focus my attention. Number 1, cash. Everything stops when a business runs out of cash. Unlike most other situations a business might encounter, cash is a problem that is almost impossible to duct tape around, kind of like oxygen. When it's gone, you're in a state of extreme emergency, and very soon thereafter, death. Your top priorities when you begin running the business end of your business are 3 things, and they're all about cash. A, cash balances. You need to examine your historical monthly cash balances, which are found on your monthly balance sheets, for the last 18 to 24 months and see whether this number is growing or declining. B, cash sources. Not all cash is created equal. Cash can be generated or used from 3 different activities: operations, investing, financing. CFO Scoreboard automatically provides you with the exact optics on your historical monthly cash flow performance in the Trends section. And finally, C, the cash burn rate. You must know exactly how much fuel you have, how fast it's being consumed, and how long until you run out. And this information is critical and is required to forecast and make informed decisions about your business. Looking backwards at historical sources and uses of cash to understand whether the problem is operating, investing, or financing is the starting point. But to truly understand the cash position of your business, you must estimate how much total fuel you have in the gas tank, and at your anticipated rate of consumption, how much time is remaining before you run out. A rolling 13-week cash forecast provides you with the CFO optics required for a thorough understanding of the business's future cash needs, and it's the single most important strategy for any business experiencing a cash crisis or a business that wants to avoid one. This is the tool that I've used for the last 40 years to manage and turn around businesses in trouble. Number 2, accounting practices. Most small businesses get started on a cash accounting method, and despite their growth, continue to use this accounting methodology. This is an incredibly bad idea. The cash accounting problem is one of the primary reasons I created CFO Scoreboard, with monthly as well as short-term, which is trailing 3 months, and long-term, which is trailing 12 months, trend lines. We need to sand and smooth out the wild monthly swings that happen as a result of cash accounting. These longer trend lines also support businesses which have either seasonality or cyclical characteristics. For businesses that have subsidized the owner's personal expenses to minimize taxes, identifying and breaking out the owner's yaya expenses into a below-the-line treatment will optimize the optics and analysis of the business's true profitability. CFO Scoreboard includes the flexibility to segregate the owner's expenses and analyze the business both before and after owner's expenses. Number 3, profits. A primary indicator of the viability and sustainability of a business model is the profitability of the business. The monthly and trailing trend line over the last several years is critical to understanding the financial dynamics of a business and whether or not the business model is viable, improving, or declining. These profitability calculations should be performed on a monetary, a common size, and a per unit basis. CFO Scoreboard performs all these calculations for you and displays the results in an easy-to-understand format. Number 4, profit margin. The profit margin of a business, which is simply profits divided by revenue, a profit margin of a business is the key metric to measure a business owner's ability to control expenses. If profit margins are declining, it is a perfect opportunity for you to identify the expense structure. In other words, cost of goods sold, variable expenses, fixed expenses, G&A, marketing and sales, and all of those trend lines. Once the problem category has been identified, you must dig deeper to find the specific expenses that are causing the profit erosion. The 2 best tools for this analysis are common sizing and per unit analysis of all the expenses on an income statement. Number 5, revenue. Understanding the revenue sources and trends for the last several years is vital for any CFO. This analysis should include trends, seasonality, cyclicality, and one-time events. In other words, the loss of a major customer. Knowing the direction of revenue, both growth and decline, and the percentage rate of movement is critical to understanding a business's future HR, employee, capital expenditure, cash and financing requirements. Finally, number 6, return on assets. The word return can be defined 2 different ways: profits or operating cash flow. You will want to monitor and maximize both. Profits divided by assets is the fundamental measure of a business's ability to convert assets into profits. Operating cash flow divided by assets, on the other hand, is the ultimate measurement of a business's success. Measuring the trend line as well as the month-over-month, year-over-year growth rates of these relationships is also critical to understanding and having optics on a business's financial condition. A business which is experiencing a deterioration of its return on assets trend line is in jeopardy. For businesses that don't have significant assets on the balance sheet, an alternative definition of assets is employees or payroll dollars. In other words, profit per employee or profit per payroll dollar. Remember, measuring absolute numbers is good. Measuring and comparing growth rates is mastery. CFO Scoreboard does both.